If you've spent any time in forex communities online, you've heard both of these terms, broker and prop firm. And if you're new, there's a good chance you've been using them interchangeably, or at least you're not entirely sure what the difference is. They are not the same thing, not even close. They operate on completely different models, they have completely different relationships with you as a trader, and understanding the distinction is genuinely important before you decide where to put your money. So let's make it make sense. Let's start with brokers, because that's the more familiar one for most beginners. A broker is a company that gives you access to the financial markets. That's their entire job. They provide you with a trading platform, they connect your orders to the market, or in some cases act as the counterparty to your trades themselves, and they make money primarily through spreads and commissions on every trade you place. When you deposit money with a broker, that money is yours. It's sitting in your trading account. Your profits are yours to keep. Your losses come out of your own balance. The risk is entirely yours. The broker doesn't particularly care whether you win or lose on individual trades. What they care about is that you keep trading, because every trade generates spread or commission income for them. Volume is their business model. Now, there are actually two main types of brokers it's worth knowing about because they operate quite differently behind the scenes. When you place a trade, your broker can handle it in two main ways. This is known as A-Book and B-Book. Let's start with B-Book first. So with B-Book, otherwise known as a market maker broker, they essentially create the market for you internally. Your trades are kept in-house, meaning the broker is effectively taking the opposite side of your position. So if you lose, they win. Now, this doesn't automatically mean something shady is going on. Many brokers use a mix of both models depending on risk, but it's important to understand how your trades are being handled. With B-Book, they're literally making the market. This doesn't automatically make them untrustworthy. Many well-regulated market makers operate completely fairly, but it does mean there's an inherent conflict of interest. If you lose, they profit directly from that loss. And if most traders, statistically speaking, lose, then as you can imagine, that would be a rather profitable business model. The second type, A-Book, otherwise known as an ECN or STP broker. ECN stands for Electronic Communication Network. STP stands for Straight-Through Processing, meaning these brokers don't take the other side of your trade. Instead, they pass your orders directly through to liquidity providers, banks, institutions, and other market participants. Their income comes from commissions, not from your losses. This removes the conflict of interest entirely. If I had to choose, I would personally go with this type of broker. For most retail traders, especially beginners, the practical difference day to day isn't huge as long as the broker is well regulated, but it's good to understand what you're dealing with. So that's a broker. You deposit your own money, you trade with it, you keep your profits, you absorb your losses. Keeping those two types of brokers in mind, let's move on to prop firms. Quick disclaimer, I'm not a financial advisor. Everything is for educational and entertainment purposes only. This is not financial advice. Trading involves significant risk. Always do your own research and only risk what you can afford to lose. Prop firm is short for proprietary trading firm, and the concept is fundamentally different. A prop firm is a company that provides capital to traders to trade with. Their money, not yours. Keep in mind, these are always fictitious funds. No one in their right mind is going to give you access to $100,000 in exchange for $800 and then refund you your $800 investment on top of that. This is monopoly money, to be 100% clear. It is possible that as you prove yourself consistently over time, that the prop firm may link real funds to your account, but I wouldn't count on it. The idea is this: you as a trader have skill, or you're trying to prove that you do, but you don't have a large amount of capital to trade with. The prop firm has capital, but wants skilled traders to grow it. So they offer a deal knowing very well that most traders fail, which is in their best interest. Anyway, you prove your trading ability by passing what's called a challenge or an evaluation. This is typically a simulated trading account where you have to hit a specific profit target, usually somewhere between 8 and 10%, while staying within certain risk rules. Things like a maximum daily loss limit and a maximum overall drawdown limit. There are a few different types of prop firm accounts. Some are one-step challenges, usually with a tighter drawdown and around 10% profit target, while others are two-step challenges, meaning there are two phases you need to pass to prove your consistency and risk management. These are usually more generous drawdown limits that mirror the profit target required, generally speaking 8 to 10% for Phase 1 and 5% for Phase 2. If you pass the challenge, the prop firm gives you a funded account, trading capital belonging to the firm that you trade on their behalf. And in return, you receive a percentage of the profits you generate as a reward, most likely paid for by other traders' failed challenges. This profit split varies between firms, but typically sits somewhere between 70 and 90% in your favour. So if you're trading a $100,000 funded account and you make $10,000 in profits, you might keep $8,000 of that and the firm keeps $2,000. Your risk is fundamentally different here compared to trading with a broker. You are not trading your own money. If you breach the risk rules, if you hit the maximum drawdown, if you lose more than the daily limit, your funded account gets closed. You don't owe the firm the money you lost, but you do lose access to the account. The only money you typically put in up front is the challenge fee, which is what you pay to attempt the evaluation. That fee can range from anywhere around $50 for a smaller account to around $1,000 for a larger one. If you fail the challenge, that fee is gone. If you pass, most prop firms refund the challenge fee with your first payout. But always check this to be sure. Some account types, like one-step challenges, may not have refundable fees. So let's put these two models side by side clearly. With a broker, you're trading your own money, you keep 100% of your profits. You absorb 100% of your losses. There's no challenge to pass. You just deposit and trade. The barrier to entry is low, but the financial risk is entirely yours. With a prop firm, you're trading the firm's money. You keep a percentage of the profits, typically 70 to 90%. You don't absorb losses beyond losing access to the account, but there's a challenge to pass first, which costs a fee, and there are strict risk rules you must follow at all times. Neither model is universally better. They serve different purposes at different stages of a trading journey. For a complete beginner who is still learning, a broker starting with a demo account and then a small live account is almost always the right starting point. You need to learn how to trade before you worry about proving it to a prop firm. Jumping straight into challenges when you don't have a solid strategy yet is just burning money on challenge fees and damaging your confidence. For your very first account, and to get used to big numbers before trying for a prop firm account, which can be psychologically tough, I would suggest using a cents account. Basically, a cents account lets you put in a small amount of money, say $100, but it will show 10,000 cents as the balance instead of a standard account showing $100. In both cases, you still have the $100 balance. Maybe I'll do a video to better cover this soon, but for now, moving on. For a trader who has a proven strategy, consistent results, and good risk management habits, a prop firm is an incredible opportunity. It lets you trade at a scale you couldn't access with your own capital alone. A $10,000 personal account becomes a $100,000 funded account. The maths on that is compelling. There are a few more things worth understanding about prop firms specifically. First is prop firms are not brokers, and they are not regulated in the same way. Most prop firm challenges take place on demo accounts or simulated environments. You're not trading in live markets during the evaluation phase. This means prop firms typically aren't subject to the same financial regulation as brokers. That's not necessarily a problem, but it does mean you need to do your due diligence on the firm's reputation before handing over a challenge fee. Second is each prop firm has its own specific rules: daily loss limits, maximum drawdown, minimum trading days, consistency rules, restrictions on trading during high-impact news events. These rules vary significantly between firms and they matter enormously. Breaking a rule, even accidentally, can get your account closed. We're going to cover prop firm rules in much more detail in a later video. Third is not all prop firms are created equal. Shocking, I know. Some are well established with a strong track record of paying out. Others are newer, less transparent, or have conditions buried in the fine print that make it very hard to actually withdraw your profits. Research before you pay a challenge fee. Look for verified payout proofs, read independent reviews, check their withdrawal process, and understand every rule before you start. And one more thing that sometimes surprises people. Because you're trading the firm's capital, not your own, prop firm trading has a different psychological dynamic to regular broker trading. When you're risking your own savings, every loss feels personal and financial. When you're trading a firm's capital, the loss still matters because you can lose your account, but it doesn't directly take food off your table. Some traders find this freeing. It removes the emotional weight of personal financial loss and lets them execute their strategy more cleanly. Others find that the challenge rules and drawdown limits create a different kind of pressure, the fear of breaching a rule and losing access. Both are legitimate experiences, and it's worth being aware of your own psychology as you approach it. So, to bring it all together, a broker gives you access to the markets to trade your own money. A prop firm gives you access to their money once you've proven your ability through a challenge. Both have a place in a trading journey, but they serve very different purposes and come with very different risk profiles. Start by learning to trade properly. Build a strategy, prove it to yourself first. Then, when you're ready, a prop firm is one of the most powerful tools available to a retail trader who wants to scale without risking large amounts of personal capital. In the next video, we're going to talk about something that catches almost every beginner completely off guard: the hidden costs of trading, spreads, commissions, and swaps, and exactly how much they're costing you on every single trade without you realizing it. See you there.